This is Silicon Valley real estate market update. We're going to start right off with an interesting slide. This is the reduction of sellers' ask prices. You can see that the bulk of Santa Clara County is blue, which means that it's favoring the buyers because more than a fifth, somewhere between a fifth and a third of the sellers are taking up price reductions. Right now for Santa Clara County, it's 26% of the sellers are taking price reductions. That is the worst out of the three counties I follow in Silicon Valley. San Mateo County is doing second best at 19% of the sellers doing price reductions, basically 1 in 5. And Alameda County has the fewest price reductions, seller price reductions. And this is the seller list price reductions prior to the offer coming in at 16%, or 1 out of 7. This is the Silicon Valley real estate marketplace for the Friday, July the 10th, presented Saturday morning, July 11th. These are the key chapters we're going over in their approximate length. If you want the handout, you can hit the QR code in the lower right-hand corner. That is for this week. It got posted around 8:30. I was a little bit early this week, which is unusual, but let's get into the data. Here is probably the most interesting slide, and it's showing the number of offers accepted in the past week in the light blue here at the bottom, then the 2 weeks for the green, 3 weeks for the dark blue, and 4 weeks for brown. The dotted line is the 10-year median. Basically, you'd expect the sales, the number from the new offers up here at that level, and roughly level. Yes, there's some fluctuation. And if you look at past 10-year medians, because that's a moving 10-year median, there is a downward tendency. But look at the sharp drop this year for 4 weeks. Now, the reason I'm doing this, I'm looking for early indicators. You also have a sharp drop in 3 weeks. You have a sharp drop in 2 weeks. And in 1 week, you see the bounce back up. And that's why I normally don't look at 1 through 4 weeks of data, is you need to stabilize the data. But this is an early indicator. When it first dropped like that, like a lead balloon, it's like, okay, that's July 4th. You know, there's excuses and there's a rebound, but now it's continuing to drop. It's bringing back with the rest. And we'll see later in the presentation, we're the second worst year now out of the last 25 years. So it's the 24th worst year. Something is going on with the number of offers being accepted. They're dropping. It's a fairly recent drop, and there really hasn't been any significant change that I'm aware of to cause it. Now let's look at an overall recap. This is some of the key metrics over on the left-hand side. The first one is a theoretical thing called turnover time. How quickly will you turn over the marketplace one time? It's currently at 48 days, which is 19% longer than normal. Your sellers are taking 1/5 longer than they would normally do to turn the marketplace over one time. That is simply a theoretical number. It's how long it would take to sell the existing inventory at the existing rate of sales if no new inventory came on the marketplace. Basically, how long a retail store could turn over their existing stock if they didn't have new shipments coming in the door and sales rate stay constant. Then when you go down to marketing time, it's 27% longer, or in 31 days, or basically approaching 4.5 weeks. Again, longer time frame. Price reductions, 1.5 times greater price reductions than they normally do, which is 1.3% off the seller's ask price. 27% shortage of offers, and we'll hear later that's what we did back in 2023 when we missed 30% of the marketplace, and then in 2024 or 2025 we were missing 20% of the marketplace. And early in 2026, it looked like we were only going to be missing 15% of the marketplace. And, you know, we're only halfway through the year. So this decrease could really change that. The one thing that's favoring the sellers is that even though all that news is pessimistic or favoring the buyers, which is why it's in blue, the shortage of inventory actually favors the seller. That's their one shining armor for the sellers. Overbidding. We're currently having an overbidding of 6.3%. You might say, Richard, that can't be that bad. But that's a full 0.5% less than we normally do at this time of the year based on the past 10 years. So you'd expect 6.8%. Now let's look at the individual graphs. Here you have this current week in the center of the graph, and that's the purple line is the actual current data. The blue is the data curve that's favoring the buyer the most. The gray is the median where you'd expect the market to be, and the red is favoring the seller the most. With theoretical turnover time, the slower the turnover time, the more favorable it is for the buyer, which is why it's up here. And you can see that you're at basically 48 days, almost 49. That would be 7 weeks. That's 20% longer. It's a full week longer than the typical 40 days that you'd expect. So you're expecting 40, you're at 48, and the slowest is at 52. And that's why you're plotted between the typical and the blue line. The reason only the colored lines go further forward to the right of this current center line is I don't have current data for next week until next week gets here. But I do have the past 10 years worth of data. So you'd expect the marketing time to basically come up and drift slowly up ever so slightly for the next several weeks. So it's basically at a plateau. And what it actually does is anybody's guess. Now we're moving over to marketing time. And yes, a lot of people look at the median or average days on market. I looked at the data, and I'm going to be changing this probably a little bit depending on the research, but I'm currently using and have been using the 75th percentile. So how long does it take 3 out of 4 sellers to sell their property? It's currently at 31 days. Typical is only 24. It's taking a whole extra week to sell the property for the typical seller. That's 25% longer than normal. Normal is about 4 weeks. Now, well, normal is about 3.5 weeks. Now you're up at 4.5 weeks. Seller price reductions. These numbers may sound really small. I'm sorry about the offset here. Something's been going wrong with this, and I reset it last week. I didn't catch it this week. This was, and I think it's because the number of weeks I grabbed was wrong. I think I'm missing 2 weeks here. I believe what the issue is based on last week is that I have 2 weeks too short into the future. And because I have 2 weeks into the future too short, it moves the current data one line over because it's a halfway point. In other words, there's 2 missing from over here. That moves half the data over by 1 week. So this current week data is actually not on the vertical blue line like it should be, but it's offset by 1 week. So anyway, it's 1.5% bigger price reductions than normal, but that's only 1.3%. So it's 50% greater than it typically is. Normally it's small. Why is it normally small? It's because in Silicon Valley, sellers and listing agents do a great job of pricing their home at or below market value, so the sellers don't have to reduce their price. And we'll get to that almost in a little bit. Right now, price reductions are still fairly small, but 1.3%, you'd only expect 0.9%. In soft marketplace, you'd expect 1.5%. So you're approaching a soft marketplace. This 1.5% is raw magnitude. This is a percentage of normal. The 2 numbers are close together, but they are still different. So this is saying you're 50% longer than typical. So you take typical, multiply it by 50%, which is basically 45, and add 45 to the 87, and you get the 130 or 1.3%. Overbidding. We had been doing better over here on the left side. So going back in the recent 13 weeks of history, we're doing slightly better, but pretty typical. Now you're below the gray line, but still pretty typical. The big question is what's going to happen going forward. You can see that the amount of overbidding in competitive marketplaces has come down significantly in the last couple of weeks. So the fact that we have a small downward pressure here may not be that significant. The actual numbers, 6.3% overbidding. Typical, what you'd expect is the 6.8%. Even in a slow marketplace, Silicon Valley at this time of the year is at 3.7%. So overbidding is something that is very common in Silicon Valley. In a competitive marketplace, it's 9% over ask price. And you'll see some of the micro markets later today are significantly more than 9%. Offers accepted. That's what I started off with. Look at it. You're now below the blue line. How much below? Well, you'd expect 2,000 in a sluggish marketplace or a cool marketplace. You're at 1,900. So you're 5% below the slowest you'd expect, the least number of offers you'd expect. And you only have to go back about 7 weeks to get to here where you were actually coming up and improving and looked like we were on a trajectory to catch the normal. And that's one of the advantages of following this data here is most people are going to be reporting on June data, and they're not going to be reporting on June data for another couple weeks, and the June data is going to still be strong. I'm reporting on stuff that happened yesterday at midnight, less than 12 hours ago, and that's where I'm sounding the alarm on is the continued decrease, and we'll see more of that come up. Inventory, you can see that you're below, you're favoring the seller. How much below are you? Right now, you're at 92%, so you have a 7.5% shortage of inventory. Not a huge, but typical is 2,800 listings. We now only have 2,600, and a very lagging, almost meaningless indicator other than this is what the industry basically runs on, at least the real estate agent's compensation runs on closed transactions. It's currently at 81% of where you'd expect it to be, just shy of 2,100. Here now is the 3 graphs. The big difference here is you're going all the way back to 2016 on the left-hand side here, up until January 1st, 2025, which is the vertical green line. You're on what I call the condensed scale. You can see that a year is from that line right here to the green vertical line. For 2025, it's double the distance, so you can see trends better, as well as for 2026. You can see that you've been jogging up and down here. And what's interesting to me, this is using a 5-week data set, which is pretty significant. It's a little bit over a month, and you're still having this kind of weekly fluctuations. That's the whole purpose of using a large period of time. And this is the turnover time. The dark line is the purple up here, turnover time. So the market accelerates, slows down, accelerates, slows down. And if you look back, yes, you have periods of time, especially for whatever reason, on the turnover time. And it may be that the turnover time is impacted by both the inventory and by the sales rate. but this oscillating back and forth, you'd expect when you're using a 5-week data set, you'd expect that to be settled out. But you can see there was a significant reversal from just last week to this week of a slowing down of the marketplace. And that's in percentage of normal. This is the market slowing down more than the market normally slows down. Here now is accepted offers. We're now down at the orange line on the bottom of the graph. Here, look at that line. It's going straight down. And as I was saying earlier at the beginning of the presentation, we were up here at 90% of the offers accepted you'd expect. But now you've come down and you're down to approaching 73%. So you're losing, and you're losing a fairly significant number, and you're losing it fairly steeply. You know, if you come back and look at this last year, this decrease, and this decrease were all much shallower than this decrease. Even the decrease that we had earlier this year was shallower. So the decrease in the rate of slowing down number of offers is steeper than you'd expect. And I'll caution you, and that's one of the disadvantages of doing this, when you cross over the green line to the left, x-axis is half the distance, so the curve is double. So even though this line here is approaching the steepness of the current, in fact, it may be slightly steeper, when you double this out because of the shortage of the scale, that becomes less. So this is one of the steepest declines that I am noticing at any time other than the typical end of the year slowdown, or it's probably equal to the end of the year typical slowdown. And it's probably not as significant, or at least hopefully not as long as duration as the pandemic shutdown right here back in 2020. I would continue to watch very carefully the offers accepted and try to figure out why the number of offers accepted is going down so significantly. And you can see it's only been in the last few weeks, because this is July 1st, so you have 2 weeks since then, and I would say maybe 3 weeks before. So it's only been going on for the last 5 weeks, which is why it's not going to impact other reporting people's data. Now, the third and final long-term graph that we're going to start off with is active inventory. You can see active inventory just a few weeks ago was higher than normal, and now it's coming down. We did have a slight positive bounce this last week, but this is why we have the shortage of inventory. Well, it's not why we have the shortage, it's showing that we have a shortage of inventory. And again, this is compared to the 10-year median for the inventory for Silicon Valley. But what are we talking about? We have been talking about the Silicon Valley real estate market. We have a lot more to talk about in Silicon Valley, which is Santa Clara, San Mateo, and Alameda counties. Then we look at the greater Bay Area. I cover 13 counties all the way up to Sacramento and all the way down to Monterey. And I'm doing that more to see if the trends that we're seeing here in Silicon Valley are local or global in nature. If you want the handout, you can either type in the green root URL plus H for handout 2026-07-11 for today's month and date, or you can hit the QR code on the top left or the longer blue Google Drive, depending on your concern about third-party links, which one you want to use. Anyway, that is as of today, so you can get that. One of the advantages of the short URL is you can get the data early. For example, it was posted at 8:30 this week. Normally, it's more like 8:50, but I was ahead of schedule. To join this presentation Saturday morning at 9 o'clock, hit the QR code on the right, the blue Zoom link, and or the green root URL plus the year 2026. The archive of these presentations is on YouTube, and that's where most of you are catching it. So you can hit the QR code on the left, you can hit the green root URL, or you can hit the blue YouTube channel. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers and sellers here in Silicon Valley. There's my contact information. Really appreciate likes and subscriptions. And then this is some additional data I can do for buyers. Adding in things like the fire zone is important, and I think becoming more important. Adding in commute times, adding in Google Map links, adding in school informations and school ratings. Whatever you as the consumer want, I'm willing to provide as long as I can find access to it. Here's some definitions of the upcoming slides, and this is the micro market areas. So here's a summary of what we're talking about. Starting to notice, look how even in the current data set, look how much absence of red there is and pink there is. Yes, there's still some pink in turnover time because you're 29 days, which is still fast, 27 days. But even that's turning more green than any other color. And then you have some slow areas down here in Alameda County, like over the Sonoma Grade area, Pleasanton, Dublin, Castro Valley, Livermore. You're talking 160 to 175 days to turn over the market one place. That's approaching 6 months worth of inventory. Now, in most of the country, that would be normal and they wouldn't be complaining at all. Here in Silicon Valley, that's a lot of inventory. That's a lot of time. I mean, the reason I use days, I consider 40 to 80 days to be normal. And, you know, that's not even 3 months. So it's double what I would consider to be a slow market for Silicon Valley. Marketing timing is a little easier for the consumer to understand. That's simply how long is it taking 3 out of 4 sellers to sell. And again, it's almost all green. There's some blue again, you know, in San Mateo County. but there's the only places that are red are the Bay cities, Redwood City, so the San Mateo County on the peninsula side there, the major cities, and then Los Altos and Palo Alto. But then you get over to price reductions, there's only one area that's blue, and that's Berkeley, and they're doing 0.6% increase in their ask price. You come over, frequency of price reductions a little bit more mixed, but again, it's a lot of blue, you know, looking, especially up in Santa Clara County. Santa Clara County only has blue and one green. You come down to San Mateo County, it's about 50-50, and Alameda County is more red, which means less price reductions. And I think that's what we saw in the graph earlier. Overbidding is a lagging indicator, but it's even now showing some blue and some green, and the reds are getting paler. The only place where you have dark reds are down here in Oakland and the city of Alameda. The turnover time is compared to normal. So this is saying what's going on to Silicon Valley compared to normal. And basically it's blue or green. Yes, I think there's 4 reds. There's one here, and there's 3 down here. So I'm seeing 5 red zones, but I don't even know. Well, it's going to be 20 times 6. So at 5 out of 120 metrics are red for favoring the seller. The rest are either neutral or favoring the buyer. We're clearly slower than we typically are for this time of the year. Offers accepted. Look at the numbers in Santa Clara County, 64%, 72%, 73%. The high is 90%. So high is 95% in Cupertino and Sunnyvale. So you're missing at least 5 to over a third of the marketplace, 5% to over a third of your marketplace is missing in Santa Clara County. San Mateo County is a lot better. You're missing half in Foster City, but that's such a small area, it really is not going to impact you. The other big one is the coast, which also is a large geographical area, but not very many transactions. That's why overall their county is at 87%, where Santa Clara County overall is 76%. And then Alameda County is doing the least well, and only missing a third of the marketplace and 2/3 of the volume you'd expect to have. Active inventory, you can see there's a shortage of inventory, which may actually explain the shortage of offers if you don't have much to pick from. But you know, they've had faster turnover time, so it could be a matter of what's available. And then up in Santa Clara County, you have the expensive areas having a real shortage of inventory. Most of the other areas are above, but even the inexpensive areas have a shortage. So it's only the middle of the marketplace that has normal inventory. Then you move over finally to appreciation. Has nothing to do with current market conditions, simply which areas have the best appreciation rate. Silicon Valley overall is at 97%. Santa Clara County is at 104%. I want to point out though, look at 104%. Each one of the micro market areas making up that 104%. The highest is 97%. So how can the cumulative be higher than the individuals? Very simply, you're selling more high-end properties than you normally do, and you're selling fewer low-end properties than you normally do. That shifts the market for the median for the county upwards, but does not shift the micro market data. And that's just one of many reasons why micro market data is more important than county-wide data. I do county-wide data for a summary, not for guidance. You have the same thing going on in San Mateo County, where their highest appreciation rate is 94%, and they're at 91%. They go all the way down to 36 and 34%. So if you just looked at these percentages, you're going, where did this 91 come from? It's all about market mix. Alameda County, you really can't see it because it's, I don't know why it's being better behaved county, but at 75%, you have things up here at 90% and 80%, and then you have some down here at 50 and 60%. And the ones that, well, Oakland is a significant percentage of all of Alameda County's data. And finally, on price, I have the median number down here in the center of the columns, and then the lowest 10% pricing on the left-hand side of the median, and the 90th percentile, the most expensive you'd expect. Now, yes, you can expect, there will be higher properties, but only 1 out of 10 properties would be higher than 5.2 million, for example, in San Mateo County. It gives you a range. It gives you a feel more than just the median number in the middle. So here now are the individual graphs. So here's your turnover time. So you can see that Santa Clara County is a little bit on the green side. So it's normal. It's in the realm of normal, but maybe a little bit slower than normal. You can see some hot spots in the West Peninsula as well as Fremont, and then also up further north in the San Mateo County, and then the island of Alameda, as well as the city of Berkeley represented here in the red. So again, you don't have the red hot marketplace that we've had in the past. It's a more balanced marketplace is what I would say, with some areas actually probably going slightly cool. Probably the slightly cool area is more like Gilroy here. See how it's sort of a blue-green, where this is a yellow-green. So yellow-green is normal to slightly better than normal. The blue-green is slightly worse than normal. Now you're looking at turnover time compared to the 10-year median. So now you look at what we typically do, and now all of a sudden those areas that look normal are bringing in blue. So this is where it says, even though it's still an aggressive market as far as the turnover time, that theoretical number, it's slower than it normally is. And there's more blue on this graph than anything. You know, all of Alameda County is slightly blue. San Mateo County is more mixed, and a good portion of Santa Clara County is also blue. The biggest exception I'm seeing right off the bat would be Los Altos and Palo Alto, where it's faster than normal. Here's marketing time. This is 3 out of 4 sellers. So how long, that means that for every 4 sellers you have, 3 are selling under this time frame, and 1 is taking longer than this time frame. And you can see again, the longer areas are in blue in color. A lot of the areas around Santa Clara, the heart of Santa Clara County, are green, and they're right around 35 days. The chart up here tells you anywhere from, and these are arbitrary decisions of how I did the color assignment. Yes, I did it based on data that I had at the time, not current data, because it's been going on. 1997 was when I first started doing it. 98 was when I first went public with my data. They were set. I've made a few minor changes, but whether it's 42 days or 40 days or 45 days, you know, I rounded it to 42 days because that's 6 weeks. And I'm a believer that real estate is a very weekly cycle. So I thought it made a little bit more sense to quote things that, well, at least benchmarks and groupings of weeks. Here's marketing time compared to normal. So you can see that, again, Santa Clara County, the heart of it is sort of blue. The more expensive areas up here are red in color, which means they're actually favoring the seller compared to normal. And you can see that it's 46%. For the time, it's taking only 3/4 of the time that it normally does in Los Altos and Palo Alto. But you go down to Cupertino, which is normally super hot on fire, and it's still going to be on fire, but it's almost double. It's 170% of the time it normally takes. Again, you can see that even though we may still be fast, we're slower than we typically are. Here's seller price reductions, and this is average, so this is just the average number. Silicon Valley is 1.3%. Santa Clara County is taking the bulk of that at 1.7%. San Mateo County is next at 1.2%, and Alameda County is taking slightly less than 1% price reduction. Look at how blue Santa Clara County is on this map. So that's the magnitude of price reduction. So price reductions versus typical, you can see that, you know, it's a mixed bag, but there isn't any red on there. I'm not seeing a single red out of 20 different micro market areas. We're basically normal to slower than normal. And again, the lime green up here is going to be slightly better than normal. The green is normal, and the blue green out in San Mateo County here is slower than normal. The blues are quite a bit slower than normal. Here's the frequency of those price reductions, of how common are price reductions. Blue means pretty common. Look how blue Santa Clara County is as a whole. I mean, there isn't, the only area that's green is Los Altos, and that's at 17%. Los Altos at 17%, and that's a very tight range because you go from 17% to 20%, and then you start going blue. It's just a very tight metric. Here's the frequency compared to normal. So you can see again, most of Santa Clara County is blue, so more price reductions than normal. The heart of Santa Clara County, right in the center along the San Tomas Expressway corridor, is green, which would be normal. Then you go more blue. San Mateo County is mostly on both sides of normal, and Alameda County is on both sides of normal, but nothing significantly above normal. It goes from basically normal to cooler than normal. Well, I guess the yellow-green here is slightly hotter than normal. Here's overbidding. So this is seeing what the buyer's competitiveness is, but the other thing it's showing you is a lag time, because we need the sold price, so you have to wait for escrows to close. On the positive side, you still have Oakland and Berkeley down here, with Oakland at 15% and Berkeley at 26% of the buy overbid. That means in Berkeley and Alameda, whatever the seller's asking, if they're asking, well, and it's not for every property, but for the average seller, if they're asking $1 million, they receive $1,025,000, $1.25 million. They're receiving 26% above their ask price at the time the offer is accepted. And they've been doing exceptionally well. I don't work that area. I have no insight of why they're doing that well, but they're doing very well. Santa Clara County is doing the least amount of overbidding at 3%, and it ranges all the way from 0.2% in Saratoga, Los Gatos, all the way up to 7% in Cupertino, Sunnyvale. But remember, this is a lagging indicator because you need that sale price, and the drop in the number of offers I was talking about earlier only has been the last 5 weeks. I would expect this overbidding to continue to drop, especially in Santa Clara County. Overbidding versus typical, you can see percentages are all under 100%. Well, one exception I'm seeing here in Los Altos at 101%. And then in San Mateo, you have 100% for the very expensive areas in Atherton. Redwood City, Belmont are all right at about 101%. Then you get down into Oakland and the city of Alameda, and they're sitting there at 101.5% and 107.5%. So quite a bit of overbidding compared to normal, even those two micro market areas in Alameda County. Here is the frequency of overbidding. The last one was magnitude, this is frequency. So even though buyers are not overbidding very much, the commonality of overbidding is huge. Don't take my pessimistic data on the magnitude of overbidding and assume you can get a price offer accepted at or below ask price. This is saying that a large percentage of the marketplace, well, basically 2/3, 64% in Silicon Valley, 60% in Santa Clara County, 67% in San Mateo County, and 68% in Alameda County of the sellers are getting more than their asking price. Now, every particular house is unique. It depends on what the ask price is and what the market value is, but the bulk of the sellers are still getting overbids. They're just not as big as they have been. Here's versus typical. And even though I just said what I said, and what I said is true, that frequency of overbidding is less common than it normally is. So 2/3 of your sellers getting overbid may sound hard to believe and unbelievable, but that's less than you normally get. Normally you're up around 70%, I think the number is. I don't have that number handy, but I think that's what it is. So your 64%, I think it was, of the sellers are getting more than their asking price is less than 70%. And that's why compared to normal, these numbers are below 100%. That's why it's so important to compare everything to normal for the same week. You can't compare real estate for the year because it's so cyclical. Here's the offers versus the 10-year median. And the reason I don't have the raw count on offers is each micro market area is a different size. So raw numbers without normalizing it would mean nothing. But look how blue that is, especially everything except for San Mateo. And even San Mateo is only green in a few areas. I mean, that to me is the story. We are just missing the buyers. The buyers have stopped doing it, and it's only been the last 5 weeks. Here's the active inventory. So you can see you got a few shortages over here in the expensive areas. Most of them is pretty normal. Here's appreciation since the last 9 months of 2015. Again, we've already talked about your count, how your county can have a higher than each one of the micro market areas. But in Santa Clara County, your least well appreciation is Los Altos, Palo Alto at 2/3. So you bought a property for $1 million, which you couldn't have done in 2015, but you bought one for $1 million in 2015. It would be worth $1,666,700 now. And that's just for the whole micro market area. There could be little shifts, but that's the concept. You can see the range in San Mateo County as well as Alameda County. Here's the prices. The middle number is the median. Like I said earlier in the presentation, the number on the left-hand side is the cheapest 10%. Number on the right is the most expensive area. So you can see what areas fit your budget. Here's the summary that we went over at the beginning. Here's some definitions of slides that are coming up. What we're doing now is we're going all the way back to 2016. We're comparing long-term. The gray line is the typical line. The blue line is the line that favors the buyer. Red line favors the sellers. Purple is the actual line. You can see the climb that we've been doing, but you normally climb, as you can see on the gray line. And this is 5 weeks data, and this is turnover time. You're climbing up, you're slowing down, but you're still under 50 days. So you're under 2 months. You're a month and a half, so you can't complain to sell out your entire inventory in a month and a half, but that's much slower than you'd expect down here, somewhere around 40 days. Here's the turnover time versus percentage normal. So you're taking 20%, 1/5 longer than you typically do. You can see it actually improved in the last 4 or 5 weeks. Has been flat here, and you can see the bounce. Here now is the marketing time. So it's taking longer and longer, and we're about 31 days for the typical seller to sell right now. And that's the 3 out of 4 sellers. So this is raw count, 31 days. Percentage basis, the marketing time is actually going down, which would suggest an improving marketplace. That's one of the reasons you have to look at so much data. Some of it's important in different times. Right now, I think the most important thing is the buyers are drying up. Because if the buyers dry up completely, we have nothing. Here's a slide I like. The highest percentage of the reductions, what's it at? 13.5%. That means the sellers are taking 13.5% off their ask price. Moving on to the average ask price, that drops down to 1.3%. The average is more indicative of the overall marketplace. but I like to see what the extremes of the market are doing. If you look at the extremes and it makes sense, then you can make sense of the stuff in between. Here's the average price reduction. So the average price reductions is getting less than normal while it's improving, because normal would be right on the gray line. This is 100% of normal. So you are taking more price reductions than normal, but they've been improving for the last quarter, which is all a positive sign. Here's the frequency in numbers. 20% of the sellers are doing a price reduction. You can see it's climbed up in the last quarter and a half from 7% to 20%. So that's a pretty significant climb. But look at it, normally climbs at this time of the year. So nothing would concern me about the frequency of seller price reductions. Here's on percentage of normal. You're what, 30% more price reductions than normal. You can see that we've been there for a lot of 2025 and 2026. Now, 2024, we were much lower because we had just come out of a pessimistic market, i.e. the 2022 price correction. So sellers were more conservative in their ask price. Overbidding, you can see the amount of overbidding is coming down. It's been coming down steeper than the gray line, but it's been basically following the trend. The steepness, in the normal line is really steep this last couple of weeks. So it may catch up again, depending on what this purple line does going forward. Where it really separated was in this period where the gray line, the typical line, is somewhat level. This year, it decided to fall during that period of time. Here's a percentage of overbidding. So if you were having the normal 6.8% overbid, you're to be here. You're only having 6.3%. You're a 0.5% below, and that's why you're at the 0.5% below the level expected level. This is the frequency of overbidding. You're halfway between the gray line up here and the blue line down here, following the normal patterns. Frequency of overbidding is slightly lower than normal. It's about 65%, 64% looks more accurate, but again, it's slightly less than normal. Here's the frequency of that overbidding for Silicon Valley. It's 90% of where it normally what you'd expect it to be. So you're missing 10% of the overbidding, but you're currently at 64%. Normally it should be about 70%. That's 6% above the 64 that it currently is at. That's why you're 10% lower. Here's the most interesting slide this week, in my opinion. The drop in the number of offers is significant, and it's more significant even this last week. So now you're down here at only 1,900 offers, where just a few weeks ago, I guess about 6 weeks ago, we were selling at 2,500 offers. So you went from 2,500 offers accepted in a 5-week period of time to 1,900 in a 5-week period of time over about a 6 or 7 week period of time. That's a pretty significant drop. And when you look at the steepness of this graph, it's steeper than any of the other decreases I'm seeing after you adjust for the fact that, for example, this decline here, which looks equally steep, but this is twice as condensed. So you have to move this out to here and then slope it, and then it becomes shallower. So this is one of the steepest drop-offs I've seen. It's not as steep as the pandemic shutdown, but that was a complete shutdown. If you look at it visually, it looks like it's about the same steep. The scary part is after you adjust for steepness in the scale, it's almost as steep as the pandemic 2022 shutdown, which was a turning off the faucet. So this has me a little confused, concerned, keeping an eye on whatever terminology you want to use. I have no explanation for this significant drop. If you look out on a percentage basis, you drop more than 20% in about 6 weeks. And so to me, that's pretty significant, especially because you're comparing this to what it normally does. Yes, it normally comes down at this time of the year, but it normally comes down 100, 200, 300. Well, actually, if I do vertical lines, it normally comes down about 200 units, and now you come down something like 600 units. So this is about 3 times steeper than it should be. And that's a concern in my book. So the real question is, why are the number of new buyers dropping off unexpectedly in a time frame when there's been really no significant news that I'm aware of? Here now is the active inventory. You can see active inventory increased this last week after the holiday, which is sort of to be expected. So you still have a little bit less inventory than you normally do. I'd expect next week to go up before we hit the peak inventory. Peak inventory is usually around July 19th. I'm not sure we'll get back up to this 3,000 benchmark again. Right now, I would actually bet against it, but anything can and does happen. So we may have already had peak inventory for 2026. Here's the pricing model, and this is all of Silicon Valley. And when you look at it this way, prices have not really come down, and that's because we're separating it out. You have the high-end prices, which have been going up. If you look right now, it's basically totally flat right here the last couple of weeks. You look at the median price, and it's rolled over and come down ever so slightly. And then if you look at the cheapest 10 percentile home, it's basically flat, although the general trend has been slightly declining. So that even shows you that on a price point basis, the market for Silicon Valley is not even doing uniformly well or poorly. Here's some definitions as we compare the three counties. It's going to be essentially the same metrics. So here you're looking at turnover time. Turnover time dipped last week because of the holiday. Now it's rebounded, and that's again just the mechanics of the holidays. Sellers don't like to put their house on the market the week of a holiday. Buyers then have nothing to make offers on the following week, and then the week after you resume normalness, and that's what we're doing. We're resuming normalness this week. Time to sell for the typical sellers. Alameda County was flat, but the other two counties are increasing, both Santa Clara and San Mateo County. Average price reductions, they're in a generally increasing amount of price reductions. So sellers are getting a lower percentage of what they're asking for in all three counties. The frequency of price reductions going up in all three counties. The least increases in Alameda County, but it's still an increase and pretty steep in both Santa Clara and San Mateo in the orange. Here's the average overbidding. You can see it's decreasing. Santa Clara by far has the least amount of overbidding at just 3%. San Mateo County is fairly flat at about 7% overbidding. Alameda County has the highest, and it has dropped, and it's now down to about 9.5% overbidding. Frequency of those overbids, Santa Clara County, the lowest frequency at 60%. San Mateo and Alameda County are very close together at 67 and 68% respectively. Offers accepted decreasing in all three counties. I'm not seeing one county that's standing out as particularly steep. Probably the steepest is Santa Clara County, which dropped to 150 units in just the last week. So it's the fact that all three counties saw a widespread decrease in the number of offers being accepted. And again, this is the decrease that I'm really not understanding why it's happening, at least the magnitude of why it's happening. Inventory is rebounded because after the holidays, and has increased in all three counties, but still reasonable. Here's your appreciation. Santa Clara County has the highest appreciation. A lot of that was market mix. And even San Mateo County was market mix because the countywide data was higher than any of the micro market areas. Only Alameda County might have been a reasonable metric, and there's no way to know without doing a lot more research. Here's your median price. Look at the drop in Santa Clara County. You've dropped from $2,050,000 in 1950. So you've lost $100,000 in sold price in just the last 2-3 weeks, probably last 3 weeks. Alameda County has lost about $75,000 from $1,375 to $1,300 in the same time frame, and San Mateo County is basically flat. Here's the median sold price on the log paper, so it's the same information, just on different graphing techniques. Here's the PITI payment for a house mortgage, assuming an 80% loan, 30-year fixed at the national high balance conforming interest rate. Clearly not the interest rate that most people here in Silicon Valley have, because most people, if they're going for a 30-year fixed, are going for jumbo money. The interest rates on jumbo money tends to be lower. You also can get relationship pricing. You can also look into adjustable rate mortgages. Here is, again, the offers accepted. We've been having sort of normal levels out of the last, basically 6th and 7th, mostly 7th place out of the last 10 years. So, not a stellar year, but also not a terrible year. For the last 3 weeks now, we've been the 9th worst year out of the last 10 based on offers accepted, and more significantly, the 24th worst year out of the last 25. So the only year with lower sales is 2023, right after that 2022 price correction, and you're even in the same order of magnitude. You're 1,910 versus 1,825. You're, for this current week, you're only off by 85 properties. That's not that much. Also, just look at the percentage of median. So you got up here around 80%, you hit 80%, then 78, and now you're down to 75% of the 10-year median. That is significant. And if you want to compare it to the 25, you were doing well up here at 186%. Then you got all the way down to 110%, then 106, and now you're back at 110%. That's percentage, not percentage of median, percentage of low on the 25-year. That's why it's over 100%. So you're only 10% higher This 1900 is only 10% higher than your previous low of 1827. I don't know how many other ways I can say it. To have the 24th worst year out of the last 25 as far as volume of offers accepted, and now we're in the third week of that, something's happened. You know, you were at the 21st position just at the end of May, 22nd, and beginning of June, you were 21st position. You know, it all depends on how you want to slice it. That's one of the problems with statistics. We can say whatever we want to say. I'm trying to represent what the market's actually doing, which is sometimes difficult because, you know, I'm trying to get there right on the leading edge before you have enough data points. And that's actually a good point. One of the reasons I want to do this weekly is I believe it takes 3 data points to establish a trend. So now you have 3, and you can do that in 3 weeks by looking at the data weekly. If you only look at the data monthly, you're a whole quarter's gone by if you're looking at 3 months worth of data. Here's the raw counts for Silicon Valley, Santa Clara County, San Mateo County, or Alameda County. There are 2 levels of appreciation, one since 2015, the second one since the pandemic in 2020. You can see that the Santa Clara County has done the best since the pandemic, as well as best overall. I'm not sure what number. Maybe the thing to point out is the offers accepted here. You have a 10% drop in Santa Clara County, which is the highest, almost 11%. And if everything was uniform, if it went to absolutely 0, the most you would expect to have, if sales were level and you have a 5-week moving period of time and you went to 0, the most drop you could have is a 20%. Now that's an oversimplification, but I'm pointing out this 10% drop in 1 week based on a 5-week moving period is pretty darn significant. Here's some definitions for 3 key metrics that we're going over on distributions. Here are the distributions. The first one's marketing time. The purple line is the current data. The dotted line is where we were a year ago. So actually marketing time across the board is a little bit faster, a little bit lower than we were a year ago. Anyway, the concept here is we start off on the dotted line a year ago and we watch which direction that dotted line moves. Does it move upwards or downwards? That's the most likely the direction the purple line will move. And it moved up slightly upwards. So basically you'd expect the purple line, the current data point, to slow down, to increase marketing time for 4 weeks, and then do a little bit of a balance and stay there for, now you're having a speed up of the marketplace at the end of September, and now it's starting to slow down again at Halloween. So you get a month period of time, the end of September to the end of October, where marketing times decrease, and now we're right there. It's probably the slowest marketing time, January 3rd, and then it rapidly increases. Look how steep it is on the right-hand side here. Now it's already slowing down, even though the bulk of the data line didn't move, and now you can see the slowdown in the overall line, and that slowdown continues. So you're covering 52 weeks on this graph, and what it's showing you is the market stays fairly constant, then it really slows down at the end of the year, does a quick acceleration before it starts slowing down for the bulk of the year. And the slowdown is sort of intermittent. Yes, there's little plateaus, and then there's a little opportunity most years, and sometime in the August, September, October timeframe, where the market tends to improve. Here's the price reductions. We're looking at the largest, so we ignore the top 2.5% for statistical fluctuations and those kinds of things, data input errors, and we go down to 17.5%. So you're looking at a 15% segment of the marketplace at the upper end of price reductions. So let's step through this and see. The purple line is the current line. We're starting off on this dotted line, and again, the concept is which direction does the dotted line go? That gives you an indication of which way the purple line will likely go. So let's watch down a little bit, then up, down, up. So it's bouncing around. So basically, I'm really not expecting much change in the purple line. Bouncing around, basically, still hasn't really changed. Now it's starting to decrease right in that the end of September timeframe through the end of October. So that October improvement, then it basically is back to the current levels again. There's January 3rd, and then boom, the price decreases start reducing. So less price reductions. There's sort of the peak right there on March the 3rd. And then sellers started getting optimistic, and so they've overjudged the marketplace, and price reductions start to increase. So basically, I don't expect much change going from this week for several weeks. We may or may not see an improvement in September, October timeframe. It all depends in large part, in my opinion, on what happens with the level of offers that sellers are getting. And the third and final distribution is overbidding, the exact same concept. Here, the dotted line is cooler, so this year is higher than we were a year ago. So we're doing better than we were last year on marketing time, price reductions, and also, well, price reductions were almost the same, and then on overbidding. So let's And overbidding is the most optimistic of the three. Let's see where direction the line goes. It's getting cooler and cooler and level and cooler. So basically, and there's probably the bottom, the end of August, and now you're getting less price reductions. So basically, I'd expect overbidding to continue to decrease through the next several weeks. There you are right there at the bottom on January 31st. Now look at the rapid improvement. The reason that happens on January 31st is the lag time to get the sold price. There's the peak around March 29th, April 12th. So call it April 7th, subtract off 35 days, and you're basically back at the end of February. So again, that ties in with my belief that the peak of the marketplace is typically right around Valentine's Day. And now you're coming up to the last couple of weeks. There's the current week. So we're doing better than last year. And I would expect the market to see less overbidding going forward. We're leaving the Silicon Valley, going into the greater Bay Area. These are the 5 regions on the left-hand side and the 13 counties that are covered in those 5 regions. Let's look at what's happening. Turnover time. Turnover time for Silicon Valley is increasing. It's increasing for the last week in all 5 regions. So it's taking longer to sell your marketplace. This is the theoretical number of how long would it take to sell out your marketplace one time. Here's your typical time. This is 3 out of 4 sellers, increasing in all 5 regions. So a slowing of the marketplace overall. But if you look back, you sort of expect that. You expect a low basically sometime during first quarter and then a slowing down basically for the balance of the year. Here you had your improvement through the first quarter and now the slowdown. And some of your counties lag behind that first quarter and roll over into early second quarter. Price reductions, increasing amount of price reductions. So again, a decreasing performance in the marketplace. All 5 regions are on a downward trajectory so increasing price reductions. Frequency of increasing price reductions, increasing. So price reductions are becoming more and more common, currently from 20% to 33%. Overbid, what's going on with overbid? A mixed bag here. Silicon Valley is clearly on the downward trend. I would actually say that the other 3 regions are flat, and the exception is North Bay, which actually I think you'd have to call as an increasing amount of overbidding. But Silicon Valley is definitely not following the trend of the other regions. Here's the frequency of overbidding. Again, I would say sort of a mixed bag here. Silicon Valley is clearly declining and fairly rapidly. You went from 72% overbids down to 64% overbids, and you did that all during second quarter. The other 4 regions I would call as level with some fluctuations. Number of offers accepted. Look at the decrease here in Silicon Valley. That's not showing up anywhere else except for the cities. The cities is sort of mirroring it to some degree, but not nearly as steep. Again, look at the steepness of the decline in Silicon Valley. And why is it happening just in Silicon Valley? Here's active inventory. I would say active inventory is increasing in all areas. All areas dipped for the holiday, July the 4th, and is now rebounded, but it's on a downward trajectory. Appreciation, everybody's all over the place, but you got 3 counties up here very close together, being Central Valley, Silicon Valley, and Central Coast. Then you have North Bay, and in last place you have is the Bay cities, or the cities, which is San Francisco and Marin. Here's your sold price for the median. You can see it's coming down for the cities. It's coming down for Silicon Valley. It's coming down for North Bay. It's come down slightly for Central Valley, but it's harder to see the declines in Central Valley because it's less. The only area where it's increasing is in the Central Coast, and that's because a lot of bounce happens in Central Coast because you have a very wide range of property values from coastal properties to King City in Monterey on the inland side. And as your market mix shifts, you can have fairly significant changes in your median price. And here's the same information, just representing in monthly payments. The only thing that impacts this is interest rates to some degree. Here's your actual numbers. The now column is the current week for this past week. The positive number says that it has increased in the last week. So it's increased from about 39.5% to 47.8%, which is an 8.3% day gain. So this is where you have to subtract the 8.3 off of the current week to get to last week's data. The market turnover time is increasing. That's a slowing down in the marketplace. Marketing time is increasing, which is a slowing down in the marketplace. Time to sell for 3/4 of the sellers to sell is increasing. So this is the median, which is more commonly followed. And this is the 75th percentile that I follow for the balance of my presentation. and you can go over all of the data the same. This is the change from 1 week ago. So it's increasing. This would be a decrease from 1 week ago on the overbidding. And here's my weeks. I basically came up with this by starting on March 1st and going forward 7 days at a time on all the way to February 21st. And then you jump forward 8 days to get back to March 1st. On leap year, I jump forward 9 days. That's why March 1st is my designated anchor, is to have one discontinuity in the data on an annual basis, which starts my first reporting date on January 3rd, which would be normally a weird start time, but you have 13 weeks in the first quarter, second quarter, third quarter, and fourth quarter, and everything lines up pretty nicely. Well, we've just been talking about the Greater Bay Area and the 13 counties in 5 regions, but the focus is on Silicon Valley, Santa Clara, San Mateo, and Alameda County. Appreciate likes and subscriptions. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers and sellers in single agency transactions. If you want to join Saturday morning at 9 o'clock, hit the QR code over in the center right, or the long blue URL here for Zoom Direct, or you can type in the shorter green root URL plus the year 2026. If you want the handout, which is the first thing I get done, I almost always get it done before 9 o'clock presentation time. Not always, but that way anybody that doesn't want to join or wants the data sooner, because it takes time to edit the video, you can get the raw data by looking at the graphs by either the green root URL plus the letter H for handout 2026, 07 for July, and 11 for today's date, or the longer drive link, which changes every week, which is why I came up with the green root URL, so you can know without having it posted. Anyway, thanks for joining. Have a great week. Take care. Bye for now.